6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, or good evening, depending on where you are in the world. My name is Patrick L. Young, the IPO video live stream, Series 5, Episode 4, that's number 28, goes live now. Coinbase options began trading, at least they're beginning their trading on the US options markets this week. The US OCC has meanwhile just announced a reduction in clearing fees. They're the good folks who clear all of the trades, removing that counterparty risk for us all throughout the cornucopia of American stock options. OCC's latest reduction will mean that they've reduced their fees by some 60% over the course of the past 3 years to reach a mesmerically tiny 2 cents. That's a 2-cent charge to clear something like, well, $30,000 worth of Coinbase stock, equivalent 100 shares per options contract. Brokerage costs for US stock options trading are generally low too. What isn't so low is the price Coinbase charges for its exchange-like activities. We touched upon this last week. You can go over to YouTube and catch the video with Sandra Rowe of the Global Blockchain Business Council. And for several days, the Exchange Invest newsletter that has been working through the minutiae of the Coinbase listing. I also wrote an article. You can catch it on capex.co. It was all about the fact that on the 301st anniversary of the South Sea Company first selling their stock to the public, Coinbase was listed on NASDAQ in New York. So in essence, Coinbase has 1,249 employees. Let's call it 1,250, but we do love the precision. It was founded in 2012. It had 43 million declared users, according to its latest results. At a $90 billion market cap, it's a little bit shy of that, I think, today. That values each user at $2,100 US. However, what we know is that only 2.8 million of those people, so that means instead of more than the population of California, we're talking about only the population of a small Baltic state, are monthly transactional users of those 2.8 million out of 43 million overall users. That values the population of a small Baltic state, provided they're all using Coinbase, at something like half a Bitcoin. Now, if you believe the expectations from Coinbase, there are now 6.1 million regular users in the current exciting frenzy of Bitcoin investment. So we're down to about, well, a quarter Bitcoin per user, something like $15,000. Then again, if that makes the projected $730 million that Coinbase is said to be going to make this year, of course, it's a big success as a big business. And certainly the achievement in scaling up so far over the course of 9 years has been little short of unbelievable. To that end, we must applaud the management. But where Coinbase options will be traded on legacy exchanges, $1 or less will buy you the exchange fees and the clearing fees at only 2 cents for $30,000 worth of stock. So in other words, half a Bitcoin. Now, Coinbase looks to be charging an eye-popping 46 to 47 basis points, that's about 0.5%, to transact Bitcoin and related cryptocurrencies. The phrase, or the word, conundrum is one which approaches the Coinbase of Coinbase stock valuation as a concept. Or some I know are minded to think sell. Because if Coinbase dropped to the sorts of fees legacy exchanges habitually trade, then it would be facing a near, well, let's put it this way, its income would be something more like $30 million and not up to the $1.8 billion that are expected this year. Now that's being generous actually at $30 million. If it charges, let's say CME for transacting euro dollars, you can shave a lump off even that $30 million income. Okay, so there are new lines of business. So they've got a proven dynamic management, and this is a big new market. But is it wrong, ladies and gentlemen, for me to have misgivings that Coinbase, with many licenses but no coherent actual regulation like the legacy exchanges, is worth more than any other exchange group in Young's pyramid? Young's simple question of cryptocurrency exchanges has long been, what happens to profits when fees drop to equivalent levels of legacy bourse players? And maybe Coinbase continues to rule. Perhaps it just buys CME with its valuable script. Certainly it's got a huge amount of optionality at an eye-popping circa $90 billion valuation. Some might have seen portentous omens in Coinbase listing on the 301st anniversary of the company's IPO, let alone the death earlier that day of the egregious fraudster Bernie Madoff, hours before Coinbase went public on the Nasdaq. Meanwhile, Gary Gensler was being confirmed by the Senate as chairman of the SEC. I've no doubt history was made on April 14th, 2021. The tricky part is, I'm just not sure what that history will prove to have been. All this and more has been already discussed in greater detail in Exchange Invest Daily, the unique newsletter of the Bourse business. Send us an email, hit me up on whatever live media stream you're watching us today. Patrick L. Young, and we can sort you out with a subscription, a free trial, no less, to Exchange Invest, the daily of the Bourse business, whether you're Coinbase or whether you're in the legacy exchange market. Our guest today is David Weisberger, and I'm really looking forward to this discussion. We're titling it Bitcoin, and with an eye towards Toy Story, we are using Buzz Lightyear's great phrase, his catchphrase no less, to infinity and beyond. Dave has been the CEO and co-founder of CoinRoutes for a number of years, but he has over 35 years of experience in market structure, quantitative finance, and trading automation. He's worked at a number of big name Wall Street banks and related trading companies, for example, Morgan Stanley, where he built their first program and electronic trading systems. Subsequently, he started the non-dollar program trading desk for Salomon Brothers. Now, there's a name to conjure with in the bond market looking back. And he became the global architect of the firm's equity trading platform, where he designed their first trading algorithm. You always remember your first trading algorithm, don't you? It's like your children. And quantitatively managed the central risk book, later running their smart order routing business before joining Two Sigma to develop and run their website their wholesale, I should say, market making. Most recently, David Weisberger was the global head of equity market structure and quantitative equity products for that fintech titan, IHS Markit. CoinRoutes, which we're going to be talking about in a moment, provides algorithmic trading and consolidated market data in a big data world, products for digital assets across multiple exchanges and liquidity providers. Dave, good to see you this evening. Where in the world are you today?
I am in sunny Miami, where a lot of people in crypto are flocking to. Beats being in New York at this time of year, and frankly, it's a fully remote business with employees on 3 different continents and everyone working remotely. It makes a lot of sense. Why not live where you really want to be?
And indeed, where the state taxes are a lot more attractive than the tri-state area of New York, one hastens to add.
This is not an insubstantial thing, but I'd prefer not to talk about such gritty details if I don't have to. But the fact is, the mayor of Miami is looking to attract crypto businesses and is generally creating a framework down here that is certainly on the right side. And so that's why we're here. But our business is global, and CoinRoutes serves clients literally in every time zone, and it's a 24/7 business. To put this in perspective, our busiest day ever for our firm, which we traded almost $200 million of crypto through our platform, was last Sunday, on a Sunday. Wow. Because of the volatility in the market. And so, our Sunday was spent, making sure that everything worked and everything worked well. But the reality is this is a very different market than anyone is used to in the traditional world.
Well, it's very exciting. It's a very volatile world. At the same time, I'm delighted to see you're getting greetings from slightly north of you in the great state of Florida from another New York tri-state refugee. Chris Messina, what a pleasure to see you once again. So great to see Dave on the show. By the way, ladies and gentlemen, you can catch me on Messy Times, the Chris Messina podcast, which I recorded just yesterday with Christopher. It's on Anchor and all of the other leading podcast sources. Messy Times, Patrick L. Young with Chris Messina. Ladies and gentlemen, if you want to ask us a question, go right ahead. The lines are open, as they always said in the charity telethons. We're not looking for charity. We're looking for your feedback and inputs. Ask us a question. What would you like to talk about today? And if you get a chance, spread a little love. I mean, be in generally a kind of Floridian attitude towards open-mindedness and being reasonable, and give us a little heart, some sort of a like at the bottom. It helps those algo AI bots, not the ones that are trading, you understand, on Two Sigma programs, but the ones that are actually trading in the world of social media to get us further up the rankings. And indeed, today we've got our social media guru in the production galley, so Veronica will tell me off if I don't keep asking you to do that. So please spare me. do give us some social media likes as the show goes on and help Dave and I get up the search engines. So Dave, you mentioned this weekend. I mean, we've had this incredible volatile spell, and it was a bit of a lover's tiff with Bitcoin as a sort of a grand, I don't know, circumlocution of several things at once.
Yeah, I mean, it's fascinating. What goes on in the markets are a combination of excess and superior technology for managing risk, which combined with that excess creates these sorts of events. Now, what do I mean by that? Let's unpack. So in the crypto world, there are a lot of traders of derivatives looking for leverage. The leverage trading through so-called perpetual swaps and futures as well, but perpetual swaps dominate, is somewhere around 5 times the amount of volume that trades in the Bitcoin spot market. This neophytes wouldn't know this, but these are on platforms. The first one was BitMEX, and their issues have been well chronicled. They're no longer number one, but you have places like FTX and Binance Futures and Bybit and Huobi and OKEX, which trade enormous amounts of perpetual swaps. Now, I say it's a superior technology because it is. In the CME futures world, or the legacy futures world, there's an old expression, I always quote it from my favorite movie in finance called Trading Places. Great 1980s movie about Eddie Murphy and Dan Aykroyd. And there's a funny scene at the end where they win and the bad guys lose, and the people from the exchange come down and say, all accounts settled at end of day. And in a modern world, the notion that your risk all comes home to roost at the end of a trading day, as opposed to throughout the trading day, is sort of an anachronism. Well, in the crypto world, all of these perpetual exchanges manage risk during the day. And if you happen to hit a point where your position needs to be liquidated, it's liquidated during the trading day. This all works really, really well, except when leverage builds up to really large amounts and people take leverage that is well beyond what we typically see in traditional markets. In traditional markets, you may have some funds which will do 5 times leverage. You might see 10 times leverage, but that's very extreme. The reality is, in the crypto world, they allow people to get to 100 times leverage. Now, I'm not saying everyone does that, but what ends up occurring is you have a lot of people who go long or go short on these very large leverage amounts, which means that a move of several $100s or $1,000 in Bitcoin could start triggering liquidations. If there's a lot of leveraged longs, then that move becomes self-sustaining. And because liquidations are price insensitive sells, meaning they're just sell at any price, that means it can literally go to any price. So this weekend, we saw across the cryptocurrency world somewhere in the neighborhood of $9 billion liquidated in a very short period of time across the crypto universe. That is 9 billion with a B. That is a lot of money to be liquidated instantaneously in the wee hours of the morning on a Saturday night, Sunday morning. The net result was Bitcoin dropping to the 52,000 range. Once the liquidations were over, it immediately bounced up into the mid 50,000s, which, to be blunt, has stayed there more or less since then. So it's been trading in a range. Now, one could talk about the causative factors and why this occurs. The same thing we saw happen famously on Thanksgiving, which, of course, on Thanksgiving, it caused lots of people to come out and say Bitcoin is dead. And so you had a similar sort of thing. Bitcoin fell significantly. We then saw another one of these falls earlier this year. It was, in February, it was less of a fall than that one, but still forced liquidations. These liquidation events tend to be overly exaggerated. One could make the argument that some of them in the past were potentially intentional. You could make that argument because there's a lot of money to be made. What happens is over the period of time leading up to the liquidation events, the arbitrage happens, meaning, let's just the simple explanation. You could sell the perpetual and buy the underlying. And so, and do that at a profit because the perpetual is trading higher, and you accumulate a large position. Now imagine a world where by selling that underlying, it creates more market impact. It causes the price to fall more than selling the perpetual. What will occur is eventually, if you start doing that, it will cause forced liquidations on the perpetual, which will cause it to pass the underlying. That sort of what's called liquidity arbitrage has been the result, has happened in many asset classes. I remember this being famously used and happening in Japan in the 90s during Nikkei's first big fall. It's happened many times since then. It's been in, whether it's been bonds. There was a strategy that was employed in the early 2000s that caused a little bit of a slap on the wrist to a large bank called Citigroup that I used to work for, because the people that built the strategy nicknamed it Dr. Evil. I'm not sure they ever would have been caught if they hadn't nicknamed the strategy Dr. Evil, but it was liquidity arbitrage. The fact is no one has proof that this is what's going on, and we don't know if this is what happened, but this is the sort of thing that kind of causes people to be worried about the Bitcoin market. What's fascinating today is, with as much bidding as there is for the underlying asset, that strategy becomes more and more dangerous. And one of these days, people who employ it will start lose a boatload of money because the buyer, it won't drop. And then they'll be short, and they don't want to be short. So it really is an interesting dynamic what's going on in the Bitcoin and in the crypto world.
So essentially, there's this big risk that these guys are going to get game stopped at some point in time when they're all in short on their liquidity shorts. And the other thing we conclude is the only thing more highly leveraged on occasion than the number of opinion writers who've written the obituary of Bitcoin is actually how many people can manage to get into that market and tend to have a slightly over-egged position across a weekend or a holiday, which seems to be the point at which they hit the sort of the nexus of their liquidity having to be unwind.
Yeah, no, that's very true. And look, we're seeing a mini version of this. You know, the other big story in the crypto world is, other than Coinbase, is Dogecoin.
Dogecoin,
riding to the moon. I mean, when you have people like Elon Musk tweeting about it, people like Mark Cuban taking Dogecoin payments for his basketball team, all of a sudden you have the Wall Street Journal writing about Dogecoin entering the market, entering the mainstream. So, you've seen that ride from, pennies to 35 cents, and which is where it is right now. It was 39 cents yesterday, and people tweeting on TikTok, hey, we want to get it to 69 cents on 420, which is today. And I'll leave it to you to know why that's funny. But you get these memes going on too, but that's no different than what was going on with GameStop. It's the same. Meme thing is happening in multiple markets around the world these days.
Yeah, I mean, there's a huge element of that memeing going on with the fascinating rise of the retail traders in the current age. Thank you very much, Rich Evans, incidentally. Good to see you, Dave. He's saying, I agree completely. It's fabulous to see you, Dave. Let's slightly change gears for a second, because we've got a super question come in from Alex Wilkinson in London, who himself, I do believe, is a director of a cryptocurrency exchange in the perpetuals business, or some end of the derivatives business, as I remember correctly. How do you find the general exchange API quality? Is it improving?
Oh boy, that's a loaded question. Okay, well, we'll start with the baseline. The baseline is, when we started 4 years ago, I would say that the average exchange API more or less resembled somewhere between the late 1980s and 1990s in terms of technology quality for trading. I would say today it's more uneven. There are several exchanges that do it well. There are many exchanges that have improved and continue to up their game, but there are still issues. The fact is that there are more native crypto developers still working at exchanges than fintech developers in many cases. And so we at CoinRoutes spend a lot of time working with exchanges on nuanced issues, such as, when you have a heartbeat, how do you get a disconnect and a heartbeat at the same time? When you see an acknowledgement for a cancel, how can it be that you, after the acknowledgement has been canceled, seconds later you could get actual fills back, and that happens. There are many issues. There is less communication about the APIs when downtime is going to happen. There are exchanges out there which, when they go down, continue to publish quotes, so you can't tell that they're down. Others, on the other hand, do it really well. They have status endpoints that say when they're up or down, so automated systems like ours can always know. The truth is, the answer to your question is, it's improving. And frankly, we're helping that improvement. We have high-level conversations with at least half a dozen crypto exchanges on a constant basis, giving feedback in terms of how they can improve. But I can tell you that there must not be that many algorithmic trading firms out there, because at least half the time that we've reported issues, we're the first ones reporting them. And maybe more than that. So it is a big deal. And from a CoinRoutes perspective, I mean, it's more of an advertisement that I like to give, but the reality is we spend a lot of time trying to help our clients navigate the exchange APIs. And we spend a lot of time helping the exchange APIs improve to be able to satisfy the needs of our clients.
Very interesting. Thank you very much for the question, Alex. Thank you for the answer, Dave. If you've got a follow-up, by all means, do follow up, Alex. It's great to hear from you this evening. Now, on a more general basis, we've got, former UNCTAD commodities market advisor, Colin Howard, who was a guest on the show just a couple of shows ago talking about digital identity. Colin is asking, so in the crypto markets, is the trading remaining a zero-sum game, in which case who's actually losing?
Yeah, I don't see it as a zero-sum game at all. I think that the fact of the matter is there's different time horizons for different players. Now, as I ran a market maker, I'm biased. I generally believe market makers serve a valuable purpose by creating liquidity at a time scale that is different than investors are demanding that liquidity. The reality is, I think the crypto market is going to grow by an order of magnitude over the next decade. It might do it faster. If in that sort of a world, investors will all gain. Traders will lose if they get over leveraged, if they trade, if they go short into, don't short into a freight train, basically, or if they don't allocate themselves right. There's no difference between crypto and any other asset class. Diversify your risk to understanding what your parameters are. Do not over leverage. Make sure you're aware of volatility, and be smart about how you're managing your funds. And if you do that, I don't think that anyone necessarily loses. Now, having said that, there is absolutely over leverage in this system. Bitcoin is volatile. A lot of the other coins and digital assets are even more volatile. And that volatility, this is a bit geeky, I apologize, is not normally distributed, meaning it's not a bell curve. The volatility of Bitcoin is actually very reasonable until it gaps. And that gap volatility is something that's very hard to model. So if you don't zoom out appropriately or look at it on the right time scale, you could end up getting knocked out of your position. So if you think you can be on 20 times margin trading in Bitcoin successfully, chances are you might make money 10 or 15 times in a row, only to lose your entire stake the 16th time when you get wiped out. So the losers are generally those that over leverage and do so with too high a percentage of their overall portfolio.
Fascinating altogether. The one area we're not seeing any volatility this evening, my producer's just telling me from the galley, is on LinkedIn. Good evening to all the viewers that we've got there. We've apparently got a reasonable and stable number. Amongst them is, of course, Alex Wilkinson, who's saying thank you very much. That was a great answer he's just received. Thanks again to Colin Howard as well for that most interesting question. And we have a super question I'm going to go straight to Plamen Nikov. So he's worrying about, tree hugging hippie green stuff. Is the energy consumption going to impede the further popularization of crypto assets?
No. I would love to stop there, but I'm going to unfortunately go on a bit of a rant. I think you should read Nick Carter, who writes about this extremely well. The reality is, if you look at the energy consumption of Bitcoin in a vacuum, you get the kinds of hard articles you see in The Guardian. If you think about the energy consumption of Bitcoin, comparing it to gold mining, all of a sudden you realize that, well, wait a minute, or as you would say on your side of the pond, hang about, it's actually dramatically lower compared to its monetary value. And as Bitcoin's price increases, that could be orders of magnitude less. If you further compare the energy consumption of Bitcoin to the energy consumption of all the computing power used in the fiat financial system, you start to realize, wait a minute, I've been had. This is one of those arguments that is a clear shell game argument. It is a clear logical fallacy. Yes, Bitcoin is mining and when mining of Bitcoin happens, it's transaction validation. That is how Bitcoin mining happens. People, the neophytes that are watching this might think mining is you're going out to hunt Bitcoin. No, that is not what's happening. What is happening is you have a competitive network of people in a truly competitive environment looking to validate the transactions and ensure the integrity of the Bitcoin network. That network validation of transactions is where mining is happening. It's not going out and stripping the natural resources in South Africa or other places and doing environmental destruction while it's pouring fossil fuels in machines into, pulling gold ore out of the ground and then mixing it with various acids into runoff, causing to get gold nuggets. It is literally you doing transaction validation. Now, why does that matter? Well, because all the other store of value, gold in particular, requires storage, requires other things. And the traditional financial markets use enormous numbers of computers. All you have to do is look at the sea of data centers in Mahwah, New Jersey, in Carteret, New Jersey, in Basildon and Slough in the UK, and you know that there's a lot of power that nobody talks about in the traditional financial sector. Every analysis I have seen shows that the environmental consumption of Bitcoin net compared to what it could become is very, very small. And yet, even with that, there are various layer 2 solutions coming online, which will bring it down substantially more. So no, I think it is a red herring argument. I thought it's a red herring argument for many times. And it's particularly red herring when you realize how much of Bitcoin mining is being powered by electricity sources that are renewable. Or even better, like flared natural gas, basically wasted energy that couldn't be used for anything else because the transmission cost of getting it other places is prohibitive. And by the way, anyone who knows anything about greenhouse gases knows that methane is substantially more greenhouse creating than carbon dioxide. So letting natural gas into the environment is not a very good thing either. So a balanced view of this would say no, and say no in spades. So sorry for the rant, but happy to set it straight.
Plamennikov, I certainly don't think you can argue that you didn't manage to get that answer straight from the heart. And I have to say, I felt that the energy was flaring off from Dave as he was trying to get his point across there. I mean, the one thing actually, just a tiny point, there's a huge discussion at the moment about transaction taxes in New York and the possibility that the New York exchanges might leave. And actually, one of the reasons they really might leave is actually because they're using so much energy in Mahwah, in New Jersey, and other areas in the data centers around about that area, that there's actually a possibility that there's not going to be enough generational capacity in the near future. And that's why it probably makes sense for them to go to somewhere like Texas, where they can actually have data centers run on renewables. So, when you compare like with like, I think it's quite a big issue. And we've got LinkedIn user. Could that possibly be Chris Messina? I'm going to use my masculine intuition and assert that it may well be, making the statement, well said, Dave. Bitcoin is, a huge economic ESG project. ES and G is the emphasis being given there. We're talking about Bitcoin to infinity and beyond, and we've got a couple of super questions coming up in a second. Oh, and actually, I take that back. The comment was from someone even more illustrious in the technological bounds, the former head of Chief Information Officer of the London Stock Exchange Group, no less, David Lester, nowadays a director of Archax, which is an up-and-coming London-based token exchange and market. Thank you for your excellent point on ESG and indeed E for electricity and environmental simultaneously when it comes to Bitcoin. Now, we've got a series of questions coming up. I'm going to do it in a quick fire order backwards. I see Robert Finney is watching on LinkedIn. Great to see you this evening, Robert. I hope all's well in your world and you're not too worried about Scottish independence. He's asking, well, Dave, when is the CoinRoutes IPO flotation?
It's funny that you asked that. We're actually doing a small Series B right now that we've turned profitable. We've been asked that question by all of our investors. We are certainly looking at some point in the next few years for a liquidity event, whether that is M&A or IPO. It is certainly something that could be possible. We have lots of reasons to believe that we could become a fairly large player in the space. As I said, profitable, trading a couple $1 billion a month right now and growing. But I don't like putting the cart before the horse, Robert, to be honest with you. Right now, we're focused on growth and delivery and execution for our clients and continuing to move on all of our core competencies. I think it's important to understand what differentiates us, though, since I made that statement, insofar as in addition to algorithmic trading and providing a really good platform for people to trade in spot Bitcoin, we have just introduced derivatives trading, which I think we're one of the only, if not the only platform for people to be able to trade algorithmically on individual or multiple swap or futures platforms. And with our arrangement with the Chicago Board of Trade, with CBOE, we have a distribution partner so that our real price metric, which we think is the best consolidated bid offer for all cryptocurrencies, could become a benchmark for both trading, i.e. transaction cost analysis and valuation. And those sorts of things, and being able to, CBOE will be able to use it for the construction of indices. We think those are all very big deals. But right now we're in really heads down building execution mode. Not any different than we were for the last 3 years during some of the crypto winter. And as crypto has rallied, we just kept building. Building is what we do and what we're going to continue to do.
Well, as you continue to build this evening, David, and we discuss Bitcoin to infinity and beyond, you've got actually an incredible building backlog of orders, questions, no less, at this point in time in the stack. Alex Wilkinson, once again, he asks, ESG, Bitcoin produced by provable green energy. Do virgin coins trade at an ever-improving spread to the traditionally produced?
I don't think so. I think that most of the price discovery is happening on centralized exchanges for Bitcoin. And I think that it's really because of the way it works, you don't actually buy or sell Bitcoin when you're trading on a CEX or on a centralized exchange, a CEX. Let's get the name right so people don't think that we're going off color. When you do that, you're buying or selling. Settlement is where coins actually move. And so they're sort of delinked. So I don't believe that's true. But what I do think is relevant is that the higher the percentage of green energy, the more Bitcoin helps people free their corporate governance from some of the profligacies of fiat. And there are many reasons to believe that that is true. It will probably become an ESG related investment over time. Today, I don't think that that's the case. I do think that there's that possibility into the future.
Very interesting. Thank you once again, Alex Wilkinson. A second brilliant question this evening. It's always good to hear from you, Alex. Rich Evans, he was making a comment earlier, and he's looking for some views here. So Rich Evans is asking, David, give us your views on Tether and how it is or is not supporting the price of Bitcoin, and whether Tether is supported by dollars.
Well, the funny part is, Rich, and Rich and I go back many years, having worked together back in the days of Salomon and beyond. And Rich has had an amazing career on his own, so props to that. The fact is, this question has been answered academically. There was a really good study, and Rich, you know how to find me. I'll happy to send it to you, which has actually proven to my conclusively to me that it's the other way around. That over the last 4 years, that Tether has expanded as the price of crypto has moved and not the other way around. So from a quantitative perspective, the models are pretty clear that despite the fear, uncertainty, and doubt FUD articles that have been written, that it's very, very clear that Tether is not the reason that Bitcoin has gone up. Bitcoin has gone up because of fundamental demand for people who believe in it. Now, I do want to get back to that fundamental demand in a heartbeat, but first let me answer the second part of the question, which is if Tether is supported by dollars. I believe they got lucky and they grew their way out of their problem. They definitely had an issue at one point. It was definitely a problem. At one point, it traded as much as a 10% discount or more to the dollar because of people concerned about their problem. But they got lucky. Unlike Bernie Madoff, may he, rot, basically. Unlike Bernie Madoff, who he got so greedy that he could never grow his way out of it, and his Ponzi scheme had to implode. Tether actually had Bitcoin backing them at one point, and pretty clearly were able to grow their way out. And several years ago, or a couple of years ago at least, when the heat came on them from the New York AG, they have switched their reserve policies. And today, from what I understand, they do a pretty good job. I don't look every day, but I have looked. They do a pretty good job of disclosing their balance sheet so that you can tell that it's more or less backed. Is it all backed by dollars? No, it's backed by assets and managed to be fully backed, but it's mostly dollars. So the answer is Tether still has maintained its market share in the stablecoin market, which frankly, I'm a little surprised by. I would have thought by now things like USDC, which are fully backed, would own that market. But no, that it's growing. But Tether still is the gateway drug for people to trade with crypto outside the United States, and as such, it's a big deal. So Tether is real. I do want to go back to the fundamental backing of Bitcoin because I think it's important for infinity and beyond to understand what I really believe. Bitcoin is essentially a perpetual option on its own chance of becoming digital gold. What do I mean by that? At a minimum, replace the monetary premium gold is afforded over its jewelry use or electronics use. And you can estimate that by comparing gold to silver or comparing gold to platinum at its heyday before Bitcoin started to eat into gold's monetary premium. If you do that, one would say that the monetary premium would be valued at a Bitcoin price of somewhere around $500,000. So the market, more or less at a $55,000 price, is saying like 12%, 10%, 11% probability of it getting there. Personally, I think Bitcoin is superior to gold in almost every way as a store of value in a digital world. So I do believe that the market is underpricing it, and therefore that is why I am bullish on it. And I think that at 55,000, that likelihood is easier to sell to investors than at 5,000 or certainly at 500 when it was just a twinkle in somebody's eye.
Well, this is certainly a discussion which is way beyond being a twinkle in somebody's eye. We're getting a lot of tangible data coming through here. Well, thank you very much, Rich, for that excellent question. Rich Evans there in the USA. We also got a very useful comment from Plamen Nakov. He just asked a great question about the electricity angles of the whole Bitcoin thing. Patrick Young, a good discussion. Enjoyed it. You're very welcome. It's all thanks to our excellent guest this evening, David Weisberger, who's giving us some super insights altogether. Now, Plamen goes on then to ask a further question, which is, how do you see the possibility of more complex derivatives being developed using Bitcoin as the underlying, and the possibility of smart contract use?
Yeah, I think that's a great question. And I once again want to delink those two. Smart contracts, I think of more from other ecosystems, whether Ethereum or developing chains like Polkadot or Cardano, if you believe in that, etc. But let's go back to derivatives. I think derivatives are a very important tool. We've already seen in 2020 and now into 2021 increasing adoption among corporates for Bitcoin as a treasury asset. As that happens, the need for hedging strategies into the future starts to grow. Right now, derivatives are used almost exclusively as a speculative demand asset, so purely financial. There's no hedging needs. But as more and more companies, as Bitcoin starts to approach that monetary value where people will consider selling it and not just holding it for that option value I described before, you will start to see the need for more balanced hedging strategies and derivatives. Now, not being an expert in derivatives, but having been adjacent to derivatives my entire career, what I can tell you is that the volatility today of Bitcoin is not remotely normally distributed. It doesn't follow a Black-Scholes model type style, meaning that because of speculation, the date skew as well as the skew of probabilities is such that it's harder to model. So complex derivatives involving Bitcoin are expensive and would therefore be hard. Now, when you talk about that, you think about things like principal protected notes and things that people might want to buy, saying, hey, I'd like to buy a bond which returns me the outperformance of Bitcoin over a certain amount. And I think you're going to see those things developing. I think as the banks get into Bitcoin and decide that Bitcoin and other cryptos are actual products that actual people want to use, then they will start developing more financial products to solve those needs. So you have both the corporate hedging side and the customer demand side from more traditional customers. Both of those will spur more derivative use over time. Right now, you'll see Deribit is one market that's a big market, and it has options. There are multiple competitors entering the space, and that's all because of the demand drivers that I just talked about. So I do think you will see more of those, and it will depend upon the use cases. Smart contracts, that's a different story. The smart contract industry, whether it's using the Bitcoin blockchain, which I'm not sure that you do so immediately, or other blockchains, is going to be huge. The reality is, and I like to tell this anecdote because it's very illustrative, the Lehman Trust from the 2008 blowup of Lehman has still not been unwound. Let that sink in, people. 13 years, there are still derivatives that have not been unwound. Why? Because derivatives have always been done by ISDA agreements, bilateral agreements that people can't step into. They're non-standardized and they're very difficult. And it's a multi-trillion-dollar market. What happens when we have the technology to standardize derivative contracts on smart contracts and allowing people to step in and out of those, understanding that there will be nuances with counterparty risk, etc. But once that happens, expect to see the entire derivatives market on this planet go digital. Will it happen tomorrow? Absolutely not. It is going to take time. Will it happen eventually? Absolutely. Is that a use case that shows that the value of the derivative of the crypto world will be orders of magnitude larger than it is today? Yes, that may be the largest driver of that. And so it's worth understanding that possibility. There are many people smarter than I am working on exactly those problems today. And it's really important to understand that when one starts to value the need to be able to trade in and out of crypto, which is why we care about it so much at CoinRoutes.
Fascinating, super answers, great value. Thank you very much. I'm actually going to jump to a very simple binary, which has been asked by David Lester. David Lester, no less, puts you on the spot, actually, at this point, Dave. Coinbase, buy or sell?
Oh, I hate that question. And if you've read the reason I hate the question is because it's a nuanced answer. And so it's really not binary. And I know I sound like a politician, but if you read, I was asked the same question by the Journal and by the FT, and I gave both the same answer that I'm going to give you, which is there is zero doubt in my mind, literally zero, that Coinbase's current margins on their current business are going to drop by over 90%. So if that's the reason you're buying Coinbase because you think their margins are going to stay there, then it's a overwhelming sell. But Coinbase also has a dominant custody business. They also own the retail franchise to begin with, which means that they're not really an exchange. You can't value them like an exchange. You have to value them like they are Charles Schwab in a world where there was no Merrill Lynch, where there was no Payne Weber back in the US. So they have those retail accounts and can monetize those if the market continues to grow in a variety of ways, including on net interest margin, on an asset-based fees, etc. So the value of Coinbase that will be determined is how well does their management team execute. If you believe in their management team, then they are a buy, certainly relative to other stocks. If you believe only in the margins of what they're currently doing and they sit on their hands, then they're a sell. Personally, I have friends who are on Coinbase's management team. So without a huge amount of conviction, I would say they are a slight buy relative to other stocks. But look, if the S&P falls, they're going to fall. If the tech sector falls, they're going to fall. If they both rally, I think they will stay in line with that because that is what they're doing. But it really, really depends upon how well their management team executes on their vision of monetizing their retail environment, retail client base, and maintaining their vertically integrated stack throughout custody as the crypto market continues to grow.
Super answer. Thank you very much. You avoided that so elegantly. I feel as if I got a very fulsome answer there, Dave. It's very useful. And as you said, you were discussing that with the Wall Street Journal and the Brussels Bugle just last week. Thank you very much, David Lester, for the question. Don't forget, while we're discussing Bitcoin to infinity and beyond, give us a little like there, ladies and gentlemen, on social media if you get the opportunity. If you'd like to read more about what's going on in the business of bourses every week, then check out Exchange Invest, exchangeinvest.com, or hit me up on whatever social media you're on today, Patrick L. Young, and we'll organize to get you sorted with a 30-day free trial. Several of the subscribers are amongst those who are actually watching today. So if you want to stay informed about the debate about bourses and the business of futures in the whole world of futures for financial markets, commodity markets at all, Exchange Invest, where it's at. We're the water cooler of the exchange business. Now, we have a super couple of questions coming in. I'm going to go to Robert Finney in just a moment. Thank you, Robert. First of all, the messy one, Christopher Messina, just slightly to the north of you in Florida, above Miami. So he's asking, Dave, what happens when the market realizes that the utility of Bitcoin is exactly the same as any other well-managed crypto coin? How rapidly does its perception as a store of value evaporate?
Well, there's a logical fallacy in that question, Chris. I'm sorry to be a bit pedantic, but the reality is it's not. There's actually been a lot written about the fact that it's not about the technology, it's about the network. If you look at the way the history of money, and you go back to seashells, which was money on the planet for thousands of years, and gold and precious metals for another couple of thousand years, what you understand is perception becomes reality. And the fact is, Bitcoin's network, and the fact that it's anonymous, the fact that it's distributed, the fact that it is what it is not about other well-managed crypto coins. I mean, you can remember when EOS debuted and people said, well, delegated proof of stake will work, etc. It won't work. There literally are no other store of value coins that are even in the same zip code, even within an order of magnitude of the kind of network that Bitcoin has for that particular use case, which is store of value. Frankly, the closest might very well be Dogecoin, which has a 5% annual inflation rate and is a meme. And that's kind of funny. Dogecoin passed Litecoin a couple days ago, and it's kind of amusing that way. All of the other large cryptocurrencies are not store of value currencies. Things like XRP, where the overhang is under control, controlled by a single company, that's not going to do it. It has nothing to do with transaction speed. It has all to do with perceived value and monetary policy. Consider the fact that since Satoshi designed Bitcoin, it's actually remarkable. There have been 4 halving events. He set a monetary policy based on based on guesses, I thought, but maybe not. Maybe he's just a lot smarter than me. He set a monetary policy which basically would continually adjust the Bitcoin network to what it would need to happen, and by the halving policy. And over 12 years, what you've seen is continued sustained growth in the network as the price has been volatile, generally risen, but been volatile. Obviously, since 17 and 18 to today, we've seen a lot of volatility. That is something that no other managed crypto could do. It would have to be well designed, and you'd have to have a reason that it's superior. I don't believe that. I think that Bitcoin has reached escape velocity at this point, certainly more than the 10% probability the market has assigned to it. Maybe I'll be wrong. I know I sound like Max Kaiser is a Bitcoin maximalist when I say that, but in the world of store of value, I am a Bitcoin maximalist. When you get to crypto as a totality, I am not, because I do see the value in use cases that go well beyond a store of value. And that's why I won't consider myself a Bitcoin maxi, but not because I think that someone's going to outcompete Bitcoin, but because I see other use cases for smart contracts and other reasons for digital assets. Uh-oh.
I've been muted. I'm terribly sorry. I was trying to spare you from some church bells in the background, ladies and gentlemen, in historic Valletta, where we're coming from today. Didn't want to be drowning out that fabulous message. Perhaps, who knows, the church is not accepting Bitcoin. Maybe they were long EOS and they're just upset. Who knows what this could have been that was going on from the many churches in the area around here. But we're with David Weisberger. He's giving us some great answers to some super questions, to which end we've got another question from Robert Finney. Robert Finney asks, does growth of blockchain as smart contracts evolve necessarily feed into cryptocurrencies?
No. Once again, the short answer is the word necessarily is the important reason I'm saying no. But of course, there's a but here. The reality is you're going to see some permissioned and some non-permissioned, public blockchains. So permissioned blockchains, such as my friend Mark Smith at Symbiont has, will clearly have a place in the evolution of smart contracts for financial products, which have nothing to do with cryptocurrencies. And I would be remiss if I did not mention that. And if Mark was watching this, he'd be mad at me if I didn't. And he's not alone. There are other clients, other companies doing so. But that said, there are public blockchains that will be used for smart contracts that will gain significant utility and already have, whether it's for, dare I say, NFTs, whether that's Ethereum or others. The notion of a non-fungible token goes well beyond just a basic art, right? So yeah, Beeple can get $69 million for a piece of digital art, sure, and that's interesting. Or you can have baseball cards or basketball cards or paintings or whatever. But non-fungible tokens can also be for real estate, could also be for ownership stakes in basically anything. And there are many, many people who are trying to build those. The blockchains those will use will almost certainly be public blockchains, aka ones denominated by cryptocurrency, for a number of reasons, most notably the ability for everybody to be able to check authenticity and for it not to be that kind of closed, accessible to fraud kind of blockchain where people could essentially hide what's going on. So I do think that there's a binary here. There's a use case for non-public blockchains in smart contracts, and there's a large set of use cases that will be. So the word necessarily, I have to say no, but in reality, it's going to be both.
Fabulous, fascinating stuff altogether. And meanwhile, I'm sure the other thing Robert Finney's probably thinking about is, do smart contracts do away with lawyers? And second of all, if you are going to do that interesting M&A deal, couldn't you possibly put a little bit of the business Robert's way as well? Because we all know a good lawyer there in the city of London, Robert Finney. Thank you, Robert, for your excellent questions. We've got a couple of good comments coming in from David Lester. You know that he was just asking about Coinbase as a buy or sell. Excellent answer. Thank you very much, David. The point about it being much more than an exchange, and indeed also you're making the custodial point about Coinbase being a particularly apt thing there. Thank you very much, Marianne Madeira. It's really, really lovely to have you commenting as always. I'm delighted that you learned so much, and it's good to have you here every week. Thank you very much for connecting to us via Facebook, and thank you also for being the first lady to appear on the show this evening, asking a question and making a comment. Now, I think this is coming again from David Lester. He's got a lightning question, as it were. Precisely, he's asking your views on the Lightning Network. DLCs, does Ethereum 2.0 get delivered?
I think Lightning is very interesting. It is a classic case of network effect. Meaning, if it achieves critical mass among pay acceptors, not payees, I guess payees, if it achieves critical mass among enough people accepting it so that the network has the liquidity inside of it, it is a very interesting technology that will help Bitcoin scale for payments. The reality is, however, what is holding Lightning back today won't hold it back if Bitcoin gets to a stable target. Considering that the vast majority of wallets are holding Bitcoin, or I should say hodling Bitcoin, to use the lingo, the reality is if you have people who believe that Bitcoin is going to go up by a factor of 8 to 10, they're not going to spend it. Lightning is an excellent solution for people who want to spend it. At some point in the price evolution of Bitcoin, it will reach an equilibrium whereby people will want to spend it more often. And when it reaches that, then I believe that technology and that network could very well make Bitcoin its transition from a pure store of value back into the original vision of the Satoshi white paper as peer-to-peer electronic payments. It's clear that Bitcoin scales as a store of value, but not as a method of payment. And my favorite analogy to this, once again, I'll give credit to Nick Carter, who, by the way, I've never met, but I read him constantly. Bitcoin basically has transactional volume similar to Fedwire, but no one will say Fedwire is going to be used to buy a cup of coffee. And Lightning is an ability for Bitcoin to be able to be used for a cup of coffee, and that could be very interesting, but probably not until it's 10x this price, would be my answer. As far as Ethereum 2.0, I can't handicap it. I'm not going to put my math skills in the same league as Vitalik. From people I know, the betting would probably be yes. The amount that's getting staked today is indicative of yes. But once again, not my area of expertise. If you made me put money on it and I had to take a side, like buy or sell, I would say yes. But don't rely on me. I am not an expert in Ethereum proof of stake or the core Ethereum dev team.
Has to be said, you may be claiming not to be a core Ethereum expert, but we've certainly got a lot of questions flocking to you this evening, Dave. You're the oracle on this network, certainly decentralized in Florida, as we look at Bitcoin to infinity and beyond. We got a comment there from Plamen Nakov. The comment about Lehman was great. That's about the unwinding of swaps still going on. So it's interesting to think about it, actually. They're still unwinding swaps at Lehman Brothers, and that's taken them 3 years longer than it took Coinbase to build the biggest by value exchange group in the world. I mean, the biggest piece of market infrastructure. That's kind of somewhat illustrative of the way of the world these days. Maybe somebody might be wanting to think about how blockchain can help, well, apart from anything else, actuaries and all the people who actually go into the business of closing businesses down like liquidators. But anyway, the comment about Lehman was great, Clement says. This is another possible huge opportunity for crypto blockchains, collateral management and optimization. I suspect we'll get David Lester saying something about that in a moment if I don't name check him right now. It's a very key point. And let me just carry on because I'll let you comment in just a moment, Dave. But Christopher Messina, he was commenting on your remarks about money. It's a very thoughtful answer, Dave. He's going to stop collecting seashells on his beach run every morning. Well, we all know Chris Messina is a big Hitchhiker's Guide to the Galaxy fan, so I suspect he's long a huge number of leaves in tune with the famous hyperinflationary monetary system that was in that particular book when all those nice telephone sanitizers reached Earth the first time. So, ladies and gentlemen, we're into the last 5 minutes. Send us a like, definitely, if you've got a chance. Make a comment, by all means. We've got more coming through. Rich Evans, here's a super question, Dave, and then you can comment on any of these remarks that we've been rushing through in the last couple of seconds. Rich Evans, what could the UK do? This is a very opposite question, given the fact that we've had Rishi Sunak announcing the possibility of a CBDC, a central bank digital currency, just in the last 24 hours. What could the UK do, asks Rich Evans, to attract more cryptocurrency ecosystem to its shores, given the UK now has flexibility, having left the EU?
I would love the opportunity to discuss with the FCA. The fact that they banned retail derivative buying was a huge mistake. What they could have done, should have done, and should still do is limit the amount of leverage to something like 5x or 3x even for retail derivatives, and only allow exchanges who are willing to testify that they can have UK citizens on limited leverage. And then they could take advantage of those ecosystems, and it would allow those products to develop. The fact that they took the broad brush, sledgehammer approach to saying you can't have an account at any of these crypto exchanges without giving the exchanges the chance to adapt their rules to UK citizens was a serious step back for the UK, who frankly I had great hopes for exactly that reason, to become a crypto hub in Europe. Because they left the EU, I thought they'd have more flexibility. Hopefully the FCA will establish a working group with people in the industry to actually look at these things. And I think that it still has that opportunity. London being one of my favorite cities, as you know, Rich, we actually have hired developers in London, or have developers working for us in London. So it's a city that we would love to be part of. But the reality is the UK regulators just did something that made it really hard for the crypto industry to flourish there, because they took a sledgehammer approach.
And ladies and gentlemen, we do not have a perpetual option on Dave's time this evening, whereas he regards, of course, Bitcoin as being a perpetual option on digital gold. We're in the last couple of minutes. Thank you very much, Alex Wilkinson, for noting once again that was a great answer. Thank you very much indeed also to David Lester, who is complimenting the show and thanking Dave for his comments. Christopher Messina, like a good hitchhiker from the Hitchhiker's Guide to the Galaxy, is going to remember his towel at all points in time. And that really leads us, I suppose, to the perfect moment at which I can say, Dave, here we are, Bitcoin to infinity and beyond. You've made the comment about the optionality of it being digital gold, the possibility that this is super ESG variation on money. I love the comments about Lightning Network. Very, very thought-provoking indeed as to where that fits into the ecosystem in a way that a lot of other things like EOS and so on clearly did not. How do you manage to see the world, how does this world pan out, and how soon do we get to infinity and beyond?
Well, I don't know about soon. I've been very good in my career at predicting meta trends and very bad at predicting timing. As Rich knows, because we started early in the world of automation and trading, we both knew that trading would be fully automated, and it took way longer than we would have expected. I would remember sitting and talking with people in the early 90s who were convinced, other technologists who were convinced that all trading would be electronic in the US within 5 years. It took 12 more beyond that. So it took 17 years from the time of that conversation. But there are things which we haven't talked about, such as dominant cartel-like activities of the big banks that frankly will be disrupted by blockchain. There's an entire movement in the world of blockchain called DeFi, which we haven't talked about, deserves its own full show. But the whole notion of distributed finance, which will effectively change the way financing activities and collateralization and arbitrage activities happen globally, and bring it far more democratically to a far wider range of people at far more competitive rates. But that is a change that's going to take a long, long time. Right now, it's all internal to crypto and being kind of the technology is being worked out. But the world is going to look different. Things like securities lending and securitization are going to happen on chain. They are going to be part of DeFi within 20 years. When does that happen? I do not know. Bitcoin itself, I believe, will be the sound money. And I do believe in the Bitcoin standard. I think that we are now past that critical mass where it will at least have gold's value as a check or as a hedge on the value of fiat currencies, particularly in the periphery of the world, but gradually moving more and more toward the center. And that's why at CoinRoutes, we kind of feel that we're sort of in the middle of it. We believe in maturation of the market. So whether it's our building of a network to build the industry's first leading dark pool, or whether it's providing tools to the average trader to be able to trade algorithmically as opposed to having to rely upon typing on keyboards, which people are doing now. That's how we look at the world. So I look at several meta trends. I look at Bitcoin as a meta trend toward being dominant money. Whether you use Max Kaiser's apex predator types of words or not, the idea that Bitcoin will start to get that monetary premium and it's an inexorable rise, I think we've reached that point. Whether or not it's Ethereum with its dominance today or an up and coming chain or all of the above, I see many, many use cases for crypto and digital assets. I further think that stock trading will ultimately all trade the same way that digital assets trade today. Why is it you can only buy Tesco in pounds sterling on a UK exchange, and maybe you could trade a GDR someplace else in some other currency? Why not be able to trade the same stock in euro or dollars or Bitcoin or Tether for that matter on the same platform? Those sorts of evolution, that becoming digital, that's what it's all about. And that's what we're at the center of.
David, that has been the most incredible hour altogether. Thank you so much. The messy one, Christopher Messina, is coming next week. We're really looking forward to that. In the meantime, if you want to warm up on a more general topic, drop by the Messy Times podcast, where I've been his guest this week. I'm really having a very lively conversation. We're looking forward to next week, where we're going to be talking about a lot of things, not so much on the distributed ledger. It could well possibly be other things that are rather more elemental to society. We shall see. David, you have brought us the most incredible discussion this evening. We've had an amazingly lively audience, absolutely superb. I'm sorry, Plamennikov, we didn't get to your question. You were continuing about the question about the UK. ECB has produced a report about introducing a digital currency, wondering what the views are in their efforts. I must admit, my view on their efforts are that, seeing as they still have a very imperfect fiat money, it might not be such a great idea for them to try a digital one at the same time. That's just my 0.02 Satoshis on the topic, which is perhaps not what David would have said himself. Whether you're bringing your towel like Chris Messina, whether you're one of those who thought that we provided great answers this evening, and I universally agree, David absolutely did. Thank you very much, Alex Wilkinson, amongst others, and Rich Evans, saying thanks, Dave, and thanks, Patrick, for what was a great discussion. I totally agree. I think actually the great discussion was very much Dave in his own part. David Lester is worried that sadly the UK is worryingly behind, which I would agree, and it's obviously got to be a matter for concern when you're building an interesting new utility such as Archax in the UK, Dave, which we all hope is going to be a huge success, of course. And it has been absolutely a super discussion, which leaves it to me to say, well, you know what, ladies and gentlemen, there's a couple of things I got to say. I mean, first of all, I used to chair a national blockchain association. I actually edited the book. Frankly, I think I learned more this evening in 1 hour with Dave than I managed to learn during three years of chairing that association in many respects. Second of all, yes, it always does take longer to get your innovation going, because that was my original best-selling book of fintech in 1999, and I thought it was all going to be happening by the time that, and we're still here, not just unwinding Lehman, actually dealing with all manner of legacy crud, basically, in the way that people are transacting the world of legacy markets. We have A new volume coming later this year of the world's most influential people in financial market structure. I can tell you one person, it's going to be no surprise to you, who's going to be a new entrant in that list, is going to be one David Weisberger, without any doubt whatsoever. Our algorithm is roaring. Ladies and gentlemen, I extort you towards victory or death with a forward by the chairman of the New York Stock Exchange, Jeffrey Sprecher, which touches upon some of the ideas of Bitcoin, blockchain, and other things. Although I have to say, I end up talking about Bitcoin as being, well, I'm maybe not such a maximalist, because I think it could be possibly and arguably the Ford Model T of cryptocurrency, but it's an interesting discussion. David, I would love to have you back on this show. We'd love to do actually the DeFi show. I think that would be really, really super. So we're going to be extending an invitation to you in the near future. David Weisberger, check out the amazing range of data products that they have. I'm very excited about the idea you're going to put together of a dark pool for the crypto industry, because I think you really do have the bona fides to do that, and that will be a very, very interesting venture. Ladies and gentlemen, my name is Patrick L. Young. I wish to thank, in addition to all of our speakers, look forward to seeing you next week with Chris Messina. Thanks to the ladies in the galley this week. We've had in the gallery Beata and Veronica. Thanks to for Ola for being our astute booker of guests. David Weisberger, you've been on IPO-VID. You've been sensational. Thank you very much, ladies and gentlemen. Thank you and good evening.